yes, I'll take credit for the creative topic that I came up with. I'm going to attest, I'm an accountant. I'm not necessarily the best at creativity. So this title tells exactly what it is that we presented to this client. Talking about this client receiving a death benefit and basically saying, well, I want to leave it for my kids. What's the best way for me to do this? Because I don't necessarily need cash. And before I get into the presentation, actually, I'm going to share with you that this was my actual deliverable. So anybody that's heard me speak or seen me present knows that whenever I'm doing a presentation to clients, I take this format. I like to present to them in a deliverable format, in a PowerPoint presentation, because I just feel like we walk through and we address the issues that we talked about in the fact-finding or discovery meeting. And most clients feel like this is an added value where we actually take time and address some of their tax issues, and then of course address the solution being the life insurance. And one other comment I'm going to say is you might be surprised. Usually I talk about corporate cases, and this is, of course, is not a corporate case. So there may be opportunities for myself or my colleagues to engage in a non-corporate case with you. Basically, this is a high net worth individual. Again, the slides that you're going to see, for the most part, are the slides that we presented to the clients, to the deliverable. I say we, this is actually my case. This is a friend of mine. And it's important that I say that because there was a few things that I had to challenge this individual on. And you'll see in a moment as I go through the slides, when I plan, I like to be conservative, but I also like to be realistic. So if I hear something, an assumption that doesn't seem realistic, if I hear that it's overly conservative and I have the ability to challenge a bit, then I'll do so. So with that in mind, let's get into the presentation. So really, what I'm trying to get at here is just the discussion of why do we put insurance in place to begin with? Why does an insured put insurance in place to begin with? Well, typically, the cases that I'm involved with and my colleagues are involved with, there's a purpose. There's a problem. It might be a tax liability problem, or it might be an issue of trapped retained earnings problem, but there's a problem and we come up with a life insurance solution to solve that problem. Now, if we think about what happens with life insurance, it's not rocket science. We're creating cash, we're creating liquidity, we're helping solve that problem. Now, if the problem is we need cash to write a check to the CRA, because of the deemed disposition rules at death, well, okay, the insurance proceeds provide exactly that solution. But what if it's just one of these cases where we want to enhance the life of our kids? We want to enhance the life of our grandkids. And I think that happens more often than not, in the sense that the recipients of the insurance proceeds don't necessarily need it. Yes, mom and dad perhaps wanted the family to get more. Surprise, surprise. Why not have the family have more instead of the CRA have more? But then when those recipients get it, then the issue becomes, okay, well, I have that cash. And this was the case with this gentleman that I was dealing with. Like I said, my friend, he received this payout on the death of his mom and dad. Unfortunately, it was a joint last to die policy. And basically he says, I don't need this cash. I don't need this money. So what I'm going to do is I'm going to put it aside. This gentleman likes to invest. So he says, I'm going to continue investing. And really, I'm not going to touch the principal. This $500,000 that I've received is going to go to my kids. I'm going to decide. I've decided that my parents have left this for my kids. And basically, I'm just an in-between. I'm a middleman. And all I'm going to do is use that income that the $500,000 will produce. I'll use that to enjoy my life. But again, that $500,000 will remain intact for my kids. Okay, so what the heck can I do for this individual? They're convinced that life insurance, another policy, is not needed because they already have a death benefit. They have a death benefit that they're going to pay forward. So how the heck can Frank actually make a case for an insurance need here? Okay, so here are the facts. These are true facts. Again, true facts as per the case and as presented. So Dom is a successful consultant operating as a sole proprietor. Successful is an understatement. This gentleman is in the top marginal tax bracket. He's married to Sarah. They have 2 sons, aged 23 and 21 years old. Over the years, Dom has accumulated wealth personally, which is invested in a self-directed investment account. So we're dealing with somebody that is a sophisticated investor. He understands stock markets and he likes to invest in the stock markets. I'm not sure if he's liking it right now. Sorry to say that. There's probably a few of us that have taken a bit of a beating right now. But Dom invests in stocks with generous dividends with a goal of capital preservation, and he tries to get a dividend yield. This is through our discussion. His goal is to get roughly around 6% annually. Dom's parents have both passed on, with the most recent passing happening last year, 2021. The passing of Dom's parents has resulted in a transition of a portion of their estate to Dom. The estate was divided such that Dom's siblings received the net proceeds from the sale of their principal residence, and Dom received the death benefit from a joint last to die policy. It was a UL policy. It was a $500,000 payout. Dom intends to deposit the proceeds in, excuse me one second, I'm just moving the ribbon from my WebEx, trying to get that out of the way. I apologize for that. So Dom intends to deposit the proceeds into his investment portfolio, and he intends to use the dividends to supplement his cash flow at retirement. And he wants to leave the original $500,000 of capital for his boys. Dom plans to retire at age 60, and he and Sarah are both 50 years of age. And Dom is open to reviewing alternatives because he's my friend, and I've told him, we can do better for you, Dom. We don't have to just stick with this plan. Okay, so here's Dom's plan. Here's what he's going to do. I did a quick spreadsheet just to summarize this for him. Dom knows these numbers inside out because, like I said, he's an astute investor. But if we look at what Dom's doing with this cash, he's going to deposit it. The $500,000 goes into the self-directed non-registered account at 6%. He's going to earn $30,000 a year. The dividend tax on that is roughly about 47%. So he's at $14,000 of tax, and the annual cash flow is about $16,000. Basically, what we're going to do is we're going to grow that every year, and as we grow that every year, we don't need any cash until later on, age 60. So at age 60, we basically stop the growth on this. And now we have a balance from $500,000 up to $684,000 approximately. Okay, at age 60, he wants to take that dividend and basically use that dividend as cash to support his needs. And he's netting about $21,000, $22,000 per year after tax. And now he's done a good thing in terms of growing that capital from $500,000 to $684,000. Not a bad plan. And when we look at age 86, mortality, I took it out to 37 years, we got roughly about $684,000. That's left for the kids, of course, because every year we're not growing that balance anymore. We're taking the money and we're using it. Okay, so Dom's plan is going to earmark that $500,000 into an investment portfolio. He's going to earn about 6% dividend, and he assumes a capital gain of 0. Dom's been in the stock market long enough to know that he's going to have ups and downs, and he says, you know what, Frank, let's ignore capital gains, just keep it simple. And I like that. Keep it simple is my motto as well. He plans to work for the next 10 years, so dividends are reinvested in the portfolio, as I showed. At age 60, Dom likes the fact that the cash flow from this portfolio can supplement other retirement income. Does Dom need the cash flow? So here's where I'm challenging a little bit. So I know Dom is overly conservative. He's not an accountant, believe it or not, but Dom is overly conservative. And here was my first challenge, was basically to say, Dom, I know you have other assets, you have a portfolio. Do you think you're actually going to need this retirement or this capital for retirement income? And I said, well, let's just for assumption's sake, let's just see what happens if you continue to reinvest. And if you continue to reinvest instead of taking the capital, because I don't think you need, I'm sorry, not the capital, but the income, but if you continue to reinvest, well, then your balance when you die is roughly going to be about $1,450,000. There, I'm just simply reinvesting the income and not taking it out. So summarizing what Dom's going to do, not a bad plan at all. Number one, if he invests and at retirement uses the cash flow, well, he'd leave his children $684,000. Remember, he received $500,000 from his parents. He reinvested the income that was earned at 6%, and the annual after tax, he took it from age 60 to 85. So he's going to leave 685,000, 684,000. If instead, the likely scenario, this is the one that I call likely because this is the one I'm going to call overly conservative. The likely scenario is that Dom's not going to need this after-tax cash. He's got ample other assets, and he's going to have roughly about $1,450,000 when he dies, just reinvesting in that dividend earning portfolio. So what if we incorporated some insurance? That's where we like to show basically where we come in and we can add value. So what if we showed Dom how we can improve this plan by including life insurance? Are we simply going to redirect $500,000 of death benefit into a policy on him and Sarah? Absolutely not. So we have to understand what makes him tick. What makes Dom tick is managing his money. So if I simply said we're going to do an insured inheritance strategy and just take that $500,000 and bleed it into a policy, and now you're going to have a policy that has a $500,000, or call it 50,000 times 10 years, because that's the example that we did. If I showed him that, I would have lost him. He wants to be able to have a tangible. He wants to be able to invest that money. So we can have both. Here's where the IFA kicks in. Here's where I'm going to show Dom, no problem, Dom. We're going to leave you with that investment portfolio, but we're also going to put a policy in place so that now we've just increased your wealth or your future wealth by adding this asset, which is not going to interrupt your current plans. And that's a very high level summary of what an IFA does. An IFA includes insurance into someone's plan without interrupting their current plans for their cash flow. I think that when people step back and peel back the layers of what it is that we're doing with an IFA, it's just simply that. It's making sure that you can continue doing what you're doing, and we're not interrupting that, because the cash flow that you put into this policy will come right back and allow you to continue to invest in this portfolio, for example. So as an aside, I'm going to quickly touch on the elements and the important elements of an IFA. I think most people on this call have heard of an IFA. I'd be surprised if anyone hasn't, but I think a refresher is always nice. So first of all, what we do, of course, is we purchase a permanent insurance policy, and we want the early cash value products. So I know most carriers, if not all carriers, have either an early cash value product, a wealth type product, or a late cash value product, an estate type product. And I know some actually have a hybrid where it's a policy that actually does a little bit of both. Let's get that part done. Let's get it underwritten. Whenever I'm working on these cases, I make sure that before we do anything, we obviously get the insurance done. But then, of course, we also want to make sure that before we place the insurance, we also have an approval on the financing side. Now, the last thing we want to do is chance it that this individual will get the financing. We're not certain. There's been cases where the banks just aren't interested in lending against this type of asset, not because of the asset. I want to be clear. The banks still have their lending criteria on IFAs. So they're looking at the borrower in addition to the insurance policy. So the insurance policy is not a problem. It's more so their view of the borrower themselves. So the second thing is, of course, we assign the policy to the lender immediately. And the reason I say immediately is because if I were to place a policy June 1st, within 2 weeks, I can have that financing back, that credit available and back to the individual. Now, don't get me wrong, there's a lot of lead time to get the approval on the financing, But once that approval is in place, and once we've placed the policy, you can imagine the purchaser of the policy, the one that's buying into this idea, wants the capital right back immediately. So typically it takes, the lenders say it'll take a couple weeks to actually administratively assign the policy, take that as security, and get that line of credit up and running. We borrow back the premium amount, and the amount that we could borrow back is 100%. That's right, it's 100%. Most of the lenders are doing 100% now, and I'm assuming a par policy, by the way. 100% of the cash value, and usually they're looking at cash value based on current minus 1% dividend scale. And by the way, we all know, or most of us know, that there's going to be a shortfall. So if I'm putting in $100,000 of premium today, my cash surrender value in year one will not be 100,000. There's going to be a shortfall. It's going to take, depending on the policy, it's going to take 4 to 5 years where I'm net even, where all the cash in equals cash surrender value. So if I want all of my money back, I'm going to have to post extra security so that the bank will give me exactly what I've put in. Number 4, I invest in income producing assets. Well, this is very important because a lot of times clients will say, well, Frank, when I borrow that money, what do I do with it? I immediately know that the IFA is not for these people. Because an IFA, when we're talking to individuals that are the right candidates, they know exactly what they're going to do with that money. They know exactly, they're going to reinvest it. Real estate individuals are really, really interested in IFAs because their goal is, well, I have 10 rental properties. I know I have a huge tax liability when I die. Either it's the rental properties are owned in a corporation or they're owned personally. So I know I have a huge capital gains issue when I die. I need the insurance, but guess what? I also need to increase that portfolio. I want more rental properties. So they're waiting at the door and they have a purpose for that borrowed money. If your client says, what am I going to do with this money? Then we shrug our shoulders and say, well, if you don't have a purpose for this money, then the IFA is not for you. Maybe it's just simply purchasing a life insurance policy for all of the excellent benefits that an insurance policy reaps. And then, of course, death benefit repays the loan and the remaining proceeds are going to go to the estate. Why are we going to leverage? Well, we're going to leverage because, as I said earlier, we need the insurance, but we also want the cash. It's not sexy for some people to put $100,000 into a policy and not have the use of it. I use the word sexy. I don't know why I use the word sexy, but feasible. There's a better word. Look at my friend Dom in this case. He wouldn't hear of putting $50,000 a year into this policy and not having the control to invest in his portfolio, yielding him 6%. And by the way, this was the example that I ran with Dom. I've done a few of these with the individuals that invest in mortgage funds or mix, and 6% is very low. They're usually on a mortgage fund or a mortgage investment corp, they're looking at getting anywhere between 8 to 10% rates of return. Now, I'm not justifying whether or not that return is achievable. If they're comfortable in that investment, good for them. So if they tell me that they can make 8 to 10%, then my job is to show them how we could get them a good loan rate and basically get them that policy as well. And of course, tax benefits. So we're not doing this with an individual that has a low marginal tax bracket. The reason is because when we borrow to invest, we're going to have a deduction of interest. Well, if I have very low income and my deduction of interest doesn't help me, well, the IFA doesn't really make sense. In addition to that, there's a deduction, and this is the only time that we're able to deduct for insurance purposes. It's when we post a policy as security for a loan. So when we post a policy as security for a loan, then we get to deduct the lower of premiums paid or payable and NCPI. NCPI standing for net cost of pure insurance. Interest deductibility, the one comment I'm going to make on this is make sure that your clients know that they are depositing into the policy from their own cash flow and then borrowing against that policy to invest. Okay, so I can't tell you how many times the client thinks that they're going to borrow to invest in the policy. There's two reasons I don't like that. A, if we borrow to invest in the policy, well, then that interest is not deductible because we're not borrowing for an income earning purpose. Insurance is it grows tax-free, so no, we don't get a deduction to deposit or for borrowed money to deposit into a life insurance policy. That's the first reason. Second reason is the banker won't buy it. At least in my experience, bankers will not fund you to make your deposit into the policy. The banker's looking for the policy to be funded by you, and then they will reimburse you, or they will basically loan against that asset that's existing. They're not fronting you the money to make the deposit into the into the policy. That's important to know. And I'm just saying that from experience. There's been a few times where the client doesn't have the cash flow. And if they don't have the cash flow to make the premium payment, well, this is not for them. And I know that we're playing around with semantics here, but honestly, you need the cash flow to make the deposit, and then the policy will be leveraged to replenish your cash flow. If you don't have the policy to make the deposit to the policy, then you can't engage in the IFA. And of course, the insurance premium deductibility rules, basically we're saying that, or the rules say that we have an assignment of the policy that's required by the lender. Lender has to be a restricted financial institution. Well, most of the lenders we're dealing with are, of course, banks. If the interest on the loan is deductible, then the lesser of premiums payable and NCPI is deductible. And the amount that we could deduct is the amount relating to the loan outstanding on the vis-a-vis the death benefit. And what about the risks? So this is important because there's many risks. I'm not going to sugarcoat this. The individual that engages in this type of activity is an individual that understands leverage and understands the fact that leverage has a lot of things that can happen to it. Let's look at interest rates, right? So these typically these loan agreements are done based on a prime, either a prime plus 1, prime plus 2. So as interest rates rise, of course, that cost of the IFA is going to rise as well. So there's an issue right there. Policy performance. Of course, we're measuring against the growth of a cash surrender value in a par plan. Now, of course, if interest rates are going up and our interest costs are going up, presumably that par policy should also perform better. But if policy performance is not performing as we illustrated, that of course is a risk as well. And most importantly, this last one is usually out of our control. Well, if I'm borrowing to invest, I want to make sure that I'm investing in something that's doing well for me, correct? I don't want to invest in something that's not doing well. So again, I'm going to use that example of the mortgage funds or mix. I'm not giving advice as to whether it makes sense to invest in a mortgage fund or a MIC. You come to us, and if you are comfortable with what you're borrowing against, that's great. But I'm not going to vet whether or not that mortgage fund or MIC is going to give you that guaranteed 8% or non-guaranteed. I shouldn't use the word guaranteed. I'm not vetting whether or not you're going to get the 8%, 10%, 12%. That's up to you to decide whether or not the leverage makes sense. So in my goofy pictures, I hope everybody is happy with very basic art that I took from the internet, of course. So here's a schematic of how the IFA works. So we have Dom and Sarah. We're going to do a joint last to die policy, and we're going to pay those premiums annually. Death benefit, of course, will go to the kids. So the actual policy that we're looking at, I'm going to lay some parameters here. It's a joint last to die, as I said. And of course, it's going to be a wealth type of product with early cash surrender values. The children are going to be the beneficiaries of the policy. The children, I'm saying children, they're 21 and 23, and presumably they'll be in their 40s and 50s when they actually collect on this policy. The policies being considered are wealth, whole life policies on a life pay. There's a reason why I use life pay, and I think most people on this call who do IFAs understand. We use a life pay because there's an obligation to pay premiums for life that allows me to take that deduction for the lower of premiums paid, and NCPI. So that's why typically we like to use life pay products instead of a 20 pay or a 10 pay. The initial sum insured on this policy was $1 million, and the premium payable is $50,000 per year. And that $50,000, of course, includes the base premium plus the extra deposit, the additional deposit, whatever you want to call it, depending on the carrier you're working with. The premium payments, and this is just me. As an accountant, I like time horizons when it comes to liabilities, when it comes to cash flows. So I'm basically showing that at year 10, if you want to stop paying this premium, absolutely, you have the ability to do so, because this policy that I'm showing offsets at current dividend scale, current -1, current -2. And of course, our paid up additions, we're going to use it to buy, our dividends, we're going to use to buy paid up additions so that we have an increase in death benefit and cash surrender value. Okay, well, after we've purchased the policy, what's the next thing we do? Well, let me go through each of these steps. So I've talked about number one. Of course, we pay the policy premium of $50,000. And again, we don't pay this premium, we don't put this in force until we know that the bank will give us the cash or will approve that loan. That's just me. I don't want to be that individual that says, we've put this in place, we don't have financing for you. I'm just, part of my process is to make sure that we have that bank financing in place. So the second thing we're doing, they put $50,000 in. I'm keeping this simple, and I'm assuming that they're going to take $50,000 back. Of course, for me to get the exact same amount in year one, I'd have to post some extra security because there's going to be a shortfall between deposit and cash surrender value. Here, I want to keep it simple. I'm saying you're going to get back your full $50,000. No problem. They take that $50,000 and they're putting it right into that investment portfolio that Dom loves to control and get his 6% back per year. So every year he's getting 6% back. And of course, at death benefit goes to the kids, and death benefit, a portion will pay off the loan. If we've done this for 10 years, I know that the loan amount will be $500,000. Everything over and above goes to the estate. And of course, there's one last step. The last step is paying the interest. Now, this isn't necessary. So it depends on the client. I like to show paying the interest because at the end of the day, I want to show that the loan amount is controlled. I don't want a runaway loan amount against this insurance policy. Is that right? No, it's not right. It's not wrong. It's just the way I like to present it. I'll tell you, there's real estate people, their eyes, and I shouldn't just pick on them, and it's not picking on them, I'm just saying the attributes that they look for. Once they see that the cash surrender value has grown substantially over the amount of loan outstanding, they immediately ask the question, why can't I continue to borrow against this policy? And the answer is yes, you can continue borrowing against the policy, or instead of borrowing against the policy, you can capitalize the interest or basically pay the interest and then re-borrow it back into your cash flow. So that's, of course, step 3. I'm showing Dom paying the interest. Why am I showing him paying the interest? Because I have that 6% dividend income coming in, and that 6% dividend income coming in, a portion of it will be used to pay the interest. Again, there's so many ways to slice and dice this, but we have to start with a core of slides to show our client. So what has resulted? Let me peel back the layers. Let me reconcile where we're at right now. Dom and Sarah are using $50,000 annually from their investment portfolio. This investment portfolio, remember, it's starting at $500,000 because that's what they received from their parents or from Dom's parents on their death. So they're using the $50,000 per year for 10 years to put cash into this joint last to die policy. Banks are going to lend 100% of cash surrender value, and it's usually CSV minus 1%, and they're going to do this in the form of a line of credit. The policy used focuses on high short-term CSVs. So of course, as I mentioned earlier, there's going to be a difference between cash surrender value and premiums paid, or basically the amount that you could take back there's going to be a shortfall unless you post up extra security. The amount borrowed will then be used to invest. No problem. Dom is going to just invest back into his portfolio. On an annual basis, Dom and Sarah are going to pay the interest on the line of credit. The interest is tax deductible along with a portion of the life insurance premium, since of course we're using this policy to secure an investment loan. Dom and Sarah will have the same investment portfolio as they would have had with no insurance. Now, saying it's the same is a little bit off. I'm going to say it's going to be a little bit less because, again, my showing of this, my presentation of this to Dom showed him actually servicing the interest on his line of credit against the insurance. So he's going to collect 6% from his dividend income, pay the interest, and I ran the interest on this loan at 4%. I was conservative when I ran this. I think interest rates were somewhere around, prime was around 2.5. So I used a 4% rate of interest on this. They will have a death benefit, and this is important. I'm on my second last point. They're going to have a death benefit that did not cost $50,000 per year, but rather the interest cost net of tax deductions. And the death benefit, and this is very important, the death benefit is going to be substantially higher. As long as we service the interest, the death benefit is going to be substantially higher than the loan outstanding. How do I know that? Well, the loan outstanding is going to be the amount of total premiums we've put into this policy. So the basics of insurance tell me that the death benefit should be higher than what I've put in. So we are naturally creating wealth here by implementing this IFA. Our loan will be the amount of premium paid, but the death benefit is going to be substantially higher. And this is where I'm telling you it's not interrupting Dom and Sarah's original plans, because they're taking that cash and they're putting it right back into the investment portfolio. Or if they were in real estate, they'd put it right back into buying a new real estate property. Or if they needed it for their operating business, they put it right back into the business for operating purposes. Okay, so this shows us the policy, and it basically shows the growth of the policy on an annual basis. So this policy has a cash surrender value, and you can see that by year 4, we're almost even. We've put in 50,000 times 4 years, so 200,000 with a cash surrender value of about 200,000. By year 5, we're at even money, so we know that we're in a good position by year 5. And here I'm showing annual loan advances. To keep it simple, I just showed Dom and Sarah 50,000 a year coming right back. They're going to have to post some security in order to get the full proceeds back, but they're not fussed about that. They could definitely post this extra security. And here's a nice thing to highlight. At year 10, not only do they have $500,000 of cash surrender value, but they have more than that. They have the $588,000. So now you can see that this ending loan balance, I'm leaving it at 500,000 because I'm choosing to service the interest every year. I'm not capitalizing. Not saying that that's the right thing for everybody. I might be working on a case with you where the individual says, hey, why would I be paying this interest? Well, yes, pay the interest and then we'll just borrow it right back. And essentially we'd be capitalizing the interest and we'd see this number continue to go up, the ending loan balance. So if we look at mortality, by year 35, they're age 85. Death benefit has grown to $2,335,000, $500,000 of ending loan balance, and our net proceeds will be $1,835,000. So let me just pause for a second there. We've just created $1,835,000 net of the loan. Net of the loan. So not a bad thing that we've done for Dom and Sarah and for their family. And I'm showing you here the loan balance. As the loan balance is increasing every year, what's happening? $50,000 is put in. I'm going to take back $50,000. Okay. And of course, for me to get that full $50,000, I'm going to need to post some extra security for a few years. And then I get into a position where I'm positive on the security side. Loan interest payments in the early years, the loan interest is very, very low. It's I use a 4% borrowing rate, probably low nowadays, but still prime is at 3.5, I believe right now. So some borrowers would still enjoy a 3.5% prime rate. But again, this is one of the risks that I talked about earlier. Interest rates are not locked in. So the borrower and the individual engaging in this has to understand that interest rates are an outlier here. By the time I reach year 10, I've got a $500,000 loan, and on an annual basis, I'm paying $20,000 of interest. Well, I'm paying $20,000 of interest. That's going against the dividend income that I'm collecting. And of course, it's reducing the taxable income that I'm reporting now on that dividend income, which is a good thing. If I look to the cash flow, my cash flow, basically, this is a reconciliation of cash. I put 50,000 in, I take 50,000 back. So I'm net zero. I pay $2,000 of interest, but I get a deduction for tax purposes. I write off roughly $966. So my actual cash outflow is about $1,000 in year 1. Take that all the way to year 10. Year 10, I've put in 50, taken back 50. Loan interest paid is $20,000 because now my loan is $500,000, $500,000 times 4%, $20,000 of loan interest paid. Get a tax deduction of about $9,900. Remember, I'm not just getting a deduction for the interest, I'm getting a deduction for the NCPI as well. And I basically have a net cash flow in that year of $10,000. So what I want to show you now, just for time purposes, I only put this one page for the net cash flow, but up to year 20, for instance, the cost of implementing this strategy was not $500,000. The cost of implementing this strategy was roughly the cumulative cash flow every year. Cumulative cash flow every year, by year 20, I've spent $153,000, not $500,000 over 10 years. Now, if I were to have put the next slide to show years 21 all the way to years 100, call it, it would, if I took another 15 years of net cash flow, assume that it's 10,000 per year, that's another $150,000 spent. So total spent on this would be roughly about 300,000, not $500,000 over 10 years, but 300,000 over 35 years. So you can see where that's a big benefit. We're basically using borrowings to our advantage to replicate our investment portfolio. And then, of course, our cash flow is coming from that investment portfolio. And really, we're doing this for net spread. Net spread meaning I'm making 6, paying off 4. But is it just net spread? No, it's not just net spread of 2%, because now I have this extra asset. The extra asset is the insurance policy. And I'm just going back a few slides to show that the insurance policy, why am I doing this? I'm doing this because I've created an extra $1,800,000 for my family. I have to be cognizant of my time, so I apologize. I'm going to pick it up a little. The tax analysis, I'm not going to go in depth into this other than the fact that I'll just touch on this. Here's why we do the pay to 100. We want that premium to be paid or payable. And then, of course, the NCPI, we look at lower of premiums paid or payable, or the NCPI, and then we take the ratio of loan to death benefit. That's what our deduction amount is. And of course, we take that amount plus our interest amount, and that gives us our total deduction. So in the later years, our total deduction becomes high. And of course, so I'm just showing you this part of it. I'm just talking about the net death benefit. But where did this $500,000 go? Well, this $500,000, of course, allowed them to continue with their investments. So their estates that they're leaving behind includes the insurance policy, net of the loan of $1,835,000, plus whatever we're able to get on the investment side. On the investment side, $500,000, I have $30,000 of dividend income. Now, of course, I have to pay interest and I have to pay tax. So my growth on that investment is not going to be as lucrative or as high as the no insurance option. Why? Because I have a drag on the growth in my investment portfolio. The drag on the growth is, of course, the interest payments that I'm making on that line of credit against the insurance. But I'm still doing okay considering I have that huge life insurance payout plus this investment portfolio that I know Dom wants. At death, the investment portfolio pays out roughly about $1 million here. Why? Of course, because we finance those interest payments every year. So let's take a snapshot, and I'm going to take a water break. So here's a snapshot of what happens when they die. Die at year 35, and at year 35, the payout on the policy is estimated to be $2,335,000. While the first payer or the first recipient of proceeds is the bank. They get their $500,000 loan repaid. The next group of people getting their cash is the beneficiaries. They're going to get $1,835,000. It's the difference. Total paid into this policy, total borrowed, $500,000 in, $500,000 taken back, and $500,000 invested into the same portfolio that Dom would have had he not done this. So he also has for his family $1,900,000. Here's my reconciliation. Dom, when we do an IFA with your investments, we're able to get you the investment balance of $1,900,000 plus the net proceeds on the insurance of $1,835,000. So we're producing roughly $2,844,000 of wealth for your family with the original $500,000 that you collected from your parents. Not bad. Dom, if you just did your own strategy of investing every year and saying, you know what, Frank, leave me alone, well, this is what you'd produce, roughly $1,450,000. So you can see that our plan is better. It's much better. It's roughly double the amount of wealth that we're leaving behind. I know that everybody's probably saying, okay, but Frank missed the boat. He's not tending or catering to what Dom said. Dom wanted some of this cash for his personal needs. Okay, no problem. Dom, we're going to address how you can get access to this money. And by the way, this is not the perfect solution. This might be the perfect solution for Dom. It is a solution. I'm sure a lot of you out there, the analyticals, are going to say, why did Frank do it this way? Frank just chose to do it this way because I thought this is a nice way to show Dom the flexibility of this plan. I'm going to repeat that. This may not be the best way for me to continue, but it was the way for me to show Dom the flexibility in this plan. Here's where I challenged Dom. I said, Dom, let's be realistic. We're friends. Do you really need cash starting at age 60? And he says, you know what? You're right. I probably don't. And I'm not in the habit of challenging people on what they want. But if I really know the individual, and I think that the assumption that they're making is overly conservative to the point of skewing us to making bad decisions, then that's where I'm going to challenge the individual and basically try to come up with a plan that is effective instead of being overly conservative and missing the boat. But he says, you know what, Frank, to make me feel comfortable, show me $50,000 of actual cash. $50,000 of actual cash in my pocket from age 70 onwards. I said, no problem, Dom, that's realistic. I can do that without a doubt. And again, this is not the perfect solution, but it's what I wanted to show him for flexibility purposes. So Dom, if you were to do your own thing and basically build up your balance and then take $50,000 a year from the portfolio at age 70, what you'd be left with is basically $473,000 per year. $473,000 is what the estate would be left with after taking $50,000 per year out for yourself. That's what you'd be left with for your family, $473,000. Now, here's where I'm going to get a little bit hairy. This is the IFA now. So please, if you don't understand this, I'm going to try to repeat it. But I did something interesting here. And people, again, might disagree with me. Remember, I did this to show him the flexibility of this. So I said, you know what, Dom? With our plan, when you reach age 70, your portfolio is worth $735,000. We're going to take $550,000 out immediately. Okay, right now everyone's scratching their head. Why the heck are you taking $550,000 out? I'm sure a lot of you are getting why I'm taking $550,000. And after I take out $550,000, we still have a balance, so we're going to continue to use the portfolio until it runs out to zero. So I repeat, at age 70, we're taking out $550,000. And then we're going to dwindle the portfolio down to nothing. okay? Well, why are we taking out 550? We're taking out 550 because I want to show Dom that he could repay this loan. Again, might not be the perfect plan, but I want to show him the flexibility. Repay this loan, and now he's got 50,000 a year from this portfolio until it dwindles down to zero. Oh my God, what happens from 75 onwards? Frank, your plan sucks. Your plan only takes me to 74. Absolutely not, because what happens is I'm showing him, who's to say we can't start borrowing against this policy again? Guess what this is? This is back-end leverage now. So again, I know people are cringing saying, Frank, why did you show it like this? This is me showing it for the flexibility purpose. I'm going to start taking a loan against this policy now for $50,000 a year. And basically by taking this loan, I'm building it up again and I'm capitalizing it now. I'm capitalizing the interest to the loan. I'm not servicing it because he needs it for retirement purposes. So what happens is that I capitalize, and at age 85, I've now built up a loan balance of $701,000. So I've taken money from age 75 to 85, 10 years of loans. Why from 75? Well, from 70 to 75, I had enough in my portfolio to fund my $50,000 need every year. And this 10 years plus accrued interest gets to 701. I die at age 85. Me and Sarah die at age 85. And the $2,335,000 pays off the $700,000 loan balance. And what does my family have left over? They have $1,600,000. Not a bad plan. How does this reconcile? Well, when we do this estate total reconciliation with the IFA, we've dwindled your investments down to zero because we've taken $50,000 a year plus the $500,000 to repay the loan at age 70. But then we have the policy net of loan amount, we have $1,634,000. Dom, if we just built up your policy or your investments and then started to take $50,000 a year from age 70 onwards, your net investments would be $473,000. So again, Dom, we're beating you out. We're showing you that our plan is more efficient, is more lucrative to your family, less lucrative to the government, to the CRA, but more lucrative to your family, and it's more lucrative by a lot. Again, let's be realistic. We showed Dom not accessing the cash. We showed Dom accessing the cash. And I showed Dom the flexibility of repaying that loan and then tapping into the loan again. So I'm happy to say that Dom went ahead with this, and he liked the way that we basically were able to show him creating more wealth by being able to do what he was going to do anyways, but now we've just tacked on a policy that's going to pay out substantially more than that loan amount. And that's essentially what we're doing with an IFA. So just to wind it all up, I'm happy to see that, I'm within 10 minutes of my ending time. Summary. So banks understand the way participating life products work, and they're going to offer you 100% leverage against the cash surrender value at -1, of course. Insurance carriers have created products that have high early cash surrender values. This has been happening for years now. This combination allows individuals like Dom and Sarah to purchase life insurance while not having their capital tied up in the life insurance product. Given the tax deduction afforded to the interest and a portion of the premium, the net cash outflow is minimal. And clearly, this strategy should be considered to produce a large capital payment to the children or grandchildren or surviving spouse. Why not consider doing 2 single life policies here? And Dom and Sarah both enjoying. Of course, the numbers won't work out as good as a joint last to die, but I'm always about, let's try to achieve and let's try to put the right combination in place to satisfy your needs, not what I think you need, but what it is that you need.
If the policy goes offset, Frank, can the client still deduct the NCPI?
Yes, that's a good question, because when we look at the formula, or the, not the formula, but the legislation for section 21E.2, it says that the premiums have to be paid or payable.
Right.
So when we do a life pay product, we actually have a legal obligation to continue paying premiums. It's just that the premiums are being paid internally via dividends instead of us actually paying the premiums. So that's a good question. And the answer is yes, we can continue to deduct the NCPI.
Okay. And in your scenario, you decided that the client decided they wanted to service the interest each year. So he's paying for that out of current cash flow to service that debt, correct?
Yeah, that's a good point, Don. So in these cases, especially when we have an investment where we have a known income, the known income in this case was the dividend. So it's easy for me because I'm saying, okay, you're telling me that you're getting 6%, and I'm going to relate this to the mortgage funds. I've done a few of these for people that are making 8 and 10%. And I'm saying this is a no-brainer because your income coming in, that cash flow of 8 to 10%, is enough to cover the 3 to 4% loan cost. So that's where I'm talking about net spread. So you're still earning a net spread of, in Dom's case, it was roughly 2%, the way I showed it. You're still earning a net spread, but you're also adding this asset called life insurance.
Okay. Of course, this question came up, and I know we prefaced this call with it was an individual. It wasn't corporately owned. It wasn't owned by a holdco. That'll be another session. But can a client who's incorporated, is the process still the same? Just the tax rates are different, correct?
Yeah, absolutely. The process is actually better.
Right.
And the reason it's better is because here we're using after-tax cash, great after-tax cash, because it came from death benefit proceeds. But in a corporation, this looks fantastic. Why does it look fantastic? Because we're using retained earnings and we're showing Dom and Sarah that the cash will come out of the corporation via the capital dividend account.
Right.
So most of these that I'm working on are coming via holdcos. And many of them, I don't want to say most of them, but many of them are from real estate investors. Again, real estate investors that have accumulated 10 to 20 to 30 to 50 properties, and they have a thirst for more properties. They have a thirst for leverage. They like leverage. They're prime candidates for this.
Well, that leads to the other question. I mean, I don't want to turn this into a corporate one, but when I go to invest my money now that I'm getting the IFA, I'm getting this money to invest in something. You're in this scenario investing in a stock portfolio where the fellow continues to grow his assets. But I could invest in his own business. I could invest in my business, another business. I could buy a building. I could buy my building and then lease my building back to me in my holdco. So it could be a real estate investment, and it could be a stock portfolio. So it doesn't really matter where they're investing as long as it's not just being to increase the size of his house.
Correct, exactly. As long as, so if we look at interest deductibility, we have to borrow for the purpose of earning income.
And that was another question that came up for someone newer to the business in terms of, you said, what does the lesser of premiums and NCPI mean in terms of deductibility? So it's the premiums or the NCPI that's deductible, whichever is less, correct?
Correct, exactly. And basically, when we look at the formula, those of us that have been in the business, we realize that NCPI number, net cost of pure insurance, obviously starts out extremely low, but in the later years, it will supersede the premiums. And basically the government's saying, no, we're not going to allow you to take that NCPI deduction. It's the lesser of premiums paid or payable and NCPI.
Right. And then calculating the NCPI, I can get that from the insurance carrier, or I can go to an illustration on Universal Life and it'll show me the NCPI in the policy. I don't know if does it do the NCPI? I guess in whole life it shows the NCPI as well.
Yeah,
right?
Absolutely. So when I'm working on a case, and I know there's some advisors that will take the data dump. Yeah. I'm not sure if that's the right word to call it, but we take the Excel data dump, and that Excel data dump has everything that you need. All carriers that I've ever worked with have that Excel data dump available.
Yeah, I think that one thing that we should mention too is that a lot of us, again, depending on where we are in our career, when we design our report, our insurance report from the carrier, we select that NCPI chart as one of the parts of the report. Not all of us in every illustration for family, business, and everything else will be incorporating the NCPI report. But look at your software and look at the design of the report and include the NCPI report as part of your report.
Yeah, I apologize, Don, because I'm just thinking about my process.
I
but
know.
of course, my process would be different. You know, if you want this NCP, and actually, let me just back up. I'd urge, if you're going to do an IFA type of a case, you don't have to engage myself or my colleagues, Chris or Brad, but engage someone that is well-versed in these, because this is the type of thing that their accountants will come back to you on an annual basis. They're going to have questions. You know, you're going to have a lot of technical questions on this. So, you know, I'd love to work with you on it. But if it's not me, just make sure it's someone that has the capability to understand this inside out. There's a lot of moving parts here. You know, it's the financing side of this is not a given.
Right.
So the more and more of these that we do, the more you realize, my gosh, like that could be a make or break, the financing. We always worry about whether or not the individual is insurable, but there's also the financing side. So please make sure that you're walking through one of these with somebody that understands it.
Yeah, I think the reason for having you on the call, Frank, is that we obviously want to engage with you, Chris, or Brad Hyde to do these things, and of course Vic Ray can get involved in the in our banking side, can get involved in the financing part of the IFA. That's his role. So, and as we move forward and have much more experience with these, we have lots of advisors that are doing this today, and where it does fall apart, in most cases, where it falls apart is not in the insurance side; it is in the qualifying financing.
Correct.
What would you say would be the limit in terms of age? Like I'm 70 years old. Does it make sense for me to do it at age 70? What kind of age target market am I looking for when I go and bring this out to my people?
Yeah, I think that every circumstance is a cop-out answer, but I'd say I would challenge it at any age. The most important thing is that when I'm borrowing, I have a viable investment to borrow and deposit into. That's the important piece. If the individual's 70 and there's a husband and wife, and we can do joint last to die, absolutely. At 70, for sure it'll work. Will it work at 80? I'm not sure. I have to test. I haven't done one for two 80-year-olds, but definitely in the early 70s, I have done them, and they work. At the end of the day, they do work.
Can you borrow a life? Like, could I borrow a child?
Don, I'm just going to interrupt. I am going to just put up, because you guys, it's already 12 or 2 o'clock.
Put up the quiz.
I'm going to put up the quiz for everybody. You guys can keep chatting.
Okay, put that quiz in the chat so you can all see it. Can you borrow a life? Can you use, let's say I'm not healthy, my wife's not healthy. Can I get an insurance policy on my child and do this?
Yes, right off the top, I'm going to say yes, as long as we can get it by underwriting in terms of the insurable interest, and making sure that we tick the boxes for that purpose.
And is there a preferred carrier? Like, I hate to ask you this question, but do you find that some carriers are more acceptable of this IFA arrangement, or are some just kind of staying away from it?
No, I think I would say that the carriers that I'm dealing with. So typically, when I'm working on a file, I ask the advisor which carrier they would like to run with, and I haven't had resistance. I think this has become very common, very common, but also uncommon in the sense that we have to be careful with how we're presenting it. If we're presenting it properly, if we're disclosing, I disclose in my cover letter when I'm submitting the application with the advisor. This will be an IFA. We have gone to so-and-so bank for financing. They want to know all of this. So I haven't had resistance in the sense that, no, as long as they have the policies to support this, and that has to be an early cash surrender value policy. Most of the carriers we work with do have that policy.
The other question is, and everybody, I always get this question, is it based on guaranteed cash value or total cash value?
Definitely total cash value, which is nice. And here's the nice thing is that we know that total cash value is made up in part by that overfunding amount, but also the dividend that we're going to receive at the end of the year. Banks are borrowing based on illustrations. So that's the nice thing, is that we don't have to wait for the year to occur for us to access it. banks are giving us the nod to say, yeah, we're going to lend against illustrations, which is fantastic.
Right. Can you comment on the tax deductibility when using an IFA and a holdco? For example, the holdco uses the borrowed money to invest and earn dividend income. However, the holdco doesn't pay any tax for earning dividend income.
Yeah, well, if I don't have income, then the deductibility doesn't really help me. So
Right.
yeah, I understand what you're asking there, whoever asked that. With respect to dividends, we're simply flowing them through. We get the RDTOH and don't pay anything in the corp. Well, I got to watch out, because then if I don't have any income to write the interest off against, then yeah, it's not really doing me any good. And
Okay.
that's a good point to say. The important thing here is, and actually it's going to make a point to why I service that interest. If
Right.
we get ourselves to a loan amount that's outrageous, because we continue to capitalize and grow that loan amount, I'm always very cautious to say, well, now you have a $2 million loan, for instance, and the interest payable, or the interest amount accruing, is $100,000. Can you absorb that $100,000 deduction?
Mm-hmm.
So let's be realistic. I don't want to be unrealistic in my presentation to the client. I want to make sure that what we're showing them is something that's viable. So if I'm showing them a deduction that is likely not going to happen, then bad on me. It's not right that we're doing that. So very, very important point to make sure that you could use that deduction.
Well, Frank, fantastic presentation. Lots of great comments in the Q&A in the chat here from today. I'm just going to go to the Q&A and see if there's anything I missed here in terms of questions. I don't think there is. This has been recorded. I will edit this probably tomorrow. It will be up on Win Big probably on Monday. So again, Frank, fantastic job. Thanks very much. I'm glad you're feeling better and back in the saddle. So we'll get you out to a live meeting soon.
Thank you.